Hello, everyone, and welcome back to BizGrow Podcast, where we connect with global leaders, educators, business leaders, founders, and CEOs across the world. Today, with me is Sean Michael Murphy, the founder of MedAx Capital, with decades of experience over investment banking, institutional finance, fundraising, capital formation, and private markets. Sean, thank you so much for joining me. Really looking forward for this conversation because I want to learn from someone who has actually operated into institutional finance and capital markets for decades. I think it's been 3 decades, right?
Yes, it's been 32 years.
Quite remarkable. So to begin with, I'd really love to know a bit more about the beginning. What attracted you to, pursue this career in finance and investment banking?
Well, I grew up in a suburb outside of New York City, and in 1969, obviously before my time, my mother was one of the first women on the floor of the New York Stock Exchange. This was during the Vietnam era, and most of the men were in the military at that point. During my adolescence, my mother would tell the stories about, basically her growing up on the floor of the New York Stock Exchange. She was only 18 years old when she started there. I started my career at 18 years old as well, fresh out of high school, and worked my way up and taught myself and read an enormous amount of books about the business and achieved all my licensing. So I'm licensed with FINRA Series 7, Series 63, 65, Series 24. I have a principal's license, and that's how I was able to establish my own firm.
It's truly remarkable. Being a licensed broker at the age of, I guess, 19, right?
19, yes. 19 is when I took
Wow.
the exam. I started at 18.
Wow, that's truly remarkable to be honest. So, how were your early years in finance, and what were some challenges that you faced during that period of time, and what were some key lessons you learned across your journey?
A couple of challenges is number one. I was very, very young, and when I was trying to get clients, that was for some people a barrier. To me, I considered being young as an asset because I had the tenacity, I had the enthusiasm, and basically the chutzpah, as you would say, to really perform under very stressful situations. I mean, we went through the '90s, the dot-com bubble. We went through the subprime housing, 9/11, working in New York on Wall Street. And I actually lived on the corner of Wall Street and Broadway my later years. Is a very stressful situation. And, we were able to thrive. I was able to do very well. I was able to see the birth of the internet on Wall Street, which is quite exciting, as I'm sure you can imagine.
That's truly remarkable. Surviving these downturns is something that not a lot of people can do. And to be honest, it's about how long you stay in business that really matters in the long run. So that's truly fantastic. So, what were some? Can you share some experiences across those multiple market cycles over these 3 decades?
Sure. I remember specifically on 9/11 when one of the planes hit, the first plane hit. I was on the phone with someone at Goldman Sachs that was in one of the towers, and she and I were discussing what was going on, and then they evacuated the building. We thought that the market at that point, it was right before the market opened that occurred. They postponed opening the market originally, and then, as you know, they closed the market for over a week in the United States because of what happened. That was very stressful because when it reopened, the markets obviously gapped significantly lower, and my phones were lit up like a Christmas tree. Everybody that had money with me was on the phone with me, and I had a significant client base at that point.
So that's a fantastic experience. To be honest, not a lot of people have experienced this. It's truly remarkable because what separates people who survive in the run in the finance industry and and the people who burn out. So, what is that distinction that separates both of them? What kept you going during those periods, and How did you, stay optimistic throughout the journey?
It's a great question. Belief in myself fueled the optimism, but what kept me going was the tenacity. And the third thing would be the relationships that I established, both with mentors on Wall Street and with clients. I, believe it or not, still have clients that I've had 30 years. That when I first started in the business gave me a shot. They gave me an opportunity, and I wasn't right all the time, but I always took their phone call and I always put my best foot forward and had a huge amount of respect in the work that they did to generate the net worths that they had, and I never looked to dissipate it in a single trade by not doing enough research or due diligence on something.
So, at what point did you start to decide your own firm and a platform instead of staying inside traditional institutions? And at what point did you think of scaling up and expanding your team and taking on more clients? Was there a specific point of time, or did it gradually happen over time?
The idea gradually happened over time. You start to think that, you want to kind of, you know, be the captain of the ship, so to speak. But what the catalyst was COVID. I was in New York City, my wife, my two twins. I had two 3-year-old twins at the time. And when COVID happened, my wife and children left New York. New York was quite dangerous at the time, I think because of the proximity that everybody lives and works and subways and things like that. So they left the city, and I was commuting from New York to Texas, where my wife is from. And eventually, it became a situation that was untenable. So I decided to move down to Texas, and when I did, I wanted a new beginning, and that's when I started MedAx Capital.
Okay, got it. So, why is the name MedAx? Is it because you specifically focus on healthcare related businesses early on?
Early on, that's correct. It was, much like Berkshire Hathaway with Warren Buffett, that was originally a seamstress or tailoring shop. That's what Berkshire Hathaway was, and it became obviously one of the biggest investing institutions on planet Earth. MedX originally, because I worked at a firm that specialized in healthcare and life sciences, one of their verticals they specialized in. I was focusing directly on that. However, as AI and edge technology started to grow, the demand from my clients was there to expand my book of business and our focus. And that's what we did. We took on experts from other verticals and we were able to do very well in it.
Seems interesting. So, for this section, I've got the last question. Then we can move on to raising capital. But for someone starting out early on in the financial world, how would you recommend they should start their career? Do you recommend the traditional path wherein they go into uh, a prestigious university and try to land a great job and then um, climb up the corporate ladder and eventually start their own firm, or how do you recommend like can someone start their own firm right away, or do you recommend building
No,
the experience?
I would recommend in any capacity that you want to move forward in this industry to get some good mentors. Those are the relationships I think that are really going to get you through not only lean times but good times. Because in the good times, when the market's going up and everybody's doing well, you want to have some perspective. And you can only get that really by working with people that have a lot of experience. So having a mentor in the business is very, very important. I think, frankly, it's more important than coming from a prestigious business school, to be very honest.
That makes sense. That was something that I expected, but it's great to know. So let's move on into raising capital. So, from your
Mhm.
experience, what is it that founders fundamentally misunderstand, and what is it that differentiates people who raise capital and the founders that fail to raise capital?
It's obviously several things. Number one, it's the leadership. And when I say leadership, I don't just mean a good idea because, look at something like Facebook. Mark Zuckerberg, when he invented Facebook, there was MySpace, there was Friendster, there were other social media platforms that were very, very similar at the time. But what he was able to do was he was able to use his enthusiasm and his vision for what he wanted Facebook to be, to basically build a better mousetrap than what everybody else had. And institutional investors, they're different than retail investors. What they wanted, the reason he got backing from big institutional investors early on is because he had clarity, he had credibility, and he had enthusiasm slash momentum. And that's what got Facebook to where it is. And now obviously it's Meta, and they're in advertising and all these other businesses.
So, what are the things that you prioritize apart from leadership? I mean, in fact, leadership is one of the most important aspects when a business is new, because initially the founder is the business. But what are some other things like traction or the market size that you prioritize?
Well, the market size is basically is in my opinion, quite frankly, overrated. People look at a TAM, a total addressable market, and they want to grab the biggest one out there when you really should niche down and become an expert. Because listen, on Earth, you could be only helping accountants, and you would have more than enough business than you'd be able to deal with for the rest of your life. But by specializing in a specific niche, the way I did with healthcare and life sciences initially, you're able to get to fill a void that exists because most people try to become generalists rather than specialists.
That perfectly makes sense. Yeah. So, are there any other things that makes a company institutionally investable?
It's got to be scalable. It's got to be something that you can scale up, and that's something that's infrastructure driven. It's not really personality driven. You've also got to have an symmetric opportunity, and that comes with limited downside and uncapped upside. Nobody invests in venture capital to make 30% or 20%. You invest in private equity and venture capital to make 10x your money. So you've got to be able to do that with operating leverage. That's the only way you can do that.
Okay, that's something that I actually did expect. So, how do you prioritize the mode of the company?
You prioritize the mode of the company. I guess you're suggesting the way that the day to day that they interact, with clear outlines and KPIs. You've got to have what your next when you do a funding round, for instance, and you're raising money, you've got to have your next two rounds planned out and what your KPIs are going to be, so that investors have clarity of where they're going to either have an exit, they're going to reinvest more capital, or hold pat and with their investment where they are.
That makes sense, yeah. So, from an investment banking perspective, let's say you are an investment banker, how do you assess whether you should take a deal or not? Are there any specific criterias that you consider before thinking that this is the right deal for me and I should take this on? And how do you judge a company through
Is
an initial review?
an initial review, I just want to know, number one, is the market large enough but also specialized? That's number one. Number two, is management credible? Okay, and are they honest? Once you're in a situation where you've invested, the greatest risk in any investment is being involved with someone you can't trust. And if the guy isn't straightforward and doesn't have the ability to deliver bad news, that's a very bad situation to be in. Can the business survive adversity? You've got to look at, downside risk. Is it capped? Is there a defensible moat? You know, is there a defensible advantage that other people can't replicate that business very easily? Are there patents, IP protections, things like that? Is there a realistic path to liquidity?
Okay, that makes sense. So, do you prioritize the raise amount or do you prioritize the quality of the company? Because a lot of the early stage capital advisory firms or boutique investment banks get carried away when they see large amounts of capital raises, including me, obviously. They get lured by the higher amounts of success fees. So, how do you balance between the two?
Well, if you really believe in your company, the success fee should be um, less important from success fee side, and the carry is what should concern you. The carry is obviously, the equity. You don't want to give away a lot of equity, although there's going to be dilution clearly on every single round that you do. But you don't want to give away too much too early on. That's the best advice I could give a founder.
I'm talking about an investment bank. Let's say you have company A and company B. Company A is
Mhm.
raising 100 million and company B is raising, let's say, 10 million. But company B seems to be more investable and, let's say, asset backed, proven revenue. And company A is sort of newish kind of company. So, as an investment banker perspective, if you choose to work with company A, the absolute amount of the success fee could be higher, but for company B,
Mhm.
the likelihood of raising capital can be higher. So, how do you choose between the two?
That's going to vary obviously from firm to firm. Every firm has a culture and a personality, just like every investment banker. So you've got more conservative firms that don't really care about the success fee. They care about how many wins versus losses they have. Those are typically the firms that I've worked for. I used to work at a company called Maxim Group in New York, and they're a very conservative firm. They do engage in riskier investments, but not to the extent of the more tried and true uh, business models that you would see out there.
Got it, got it. That makes sense. So, let's shift our focus a bit on AI. So, how is AI truly impacting investment banking? What are the areas that are most affected, and how can smaller size investment banks as well as larger bankers benefit by channeling AI in a way that they can streamline the process and improve the chances of success?
Well, the first thing it does is it really levels the playing field between big institutional firms and smaller boutiques because you can do significant amounts of due diligence with a much lower head count. It won't replace good investments. Good investments will still be good and bad investments will still be bad, but it'll amplify the returns and the speed at which those returns are achieved, no doubt.
So, would you recommend preparing, documents using AI?
Absolutely, but there's also the problem with hallucinations. So you've got to have some ability to, you know, tr you trust, but you verify all the
Totally,
data,
totally.
obviously. I use several programs to verify all footnotes and citations that I have in any of my reports.
Okay. So, lastly, in this section, what advice would you give to any founder who's raising capital for the first time?
Well, if they're raising money for the first time, I would ask them to honestly look at the deal and determine who they're looking to get to back that deal. Everybody wants Sequoia Capital to back them, but at the end of the day, it might not be an institutional deal at that point. It might be for, high net worth and ultra high net worth investors. It might be a retail deal. So you've got to be frank and honest with yourself in the beginning. Then, once you've decided whether it's going to be a high net worth, ultra high net worth investor or an institution, you've then got to break down, what vertical these people are in and if they're currently writing checks. Because you've got a finite amount of face time that you can go out there and meet with these investment banks for. You've got to make sure that when you shoot your shot, you're with the right person.
Sure, sure. So, can you share like an example of a founder who totally impressed you immediately, and what made them stand out? Obviously,
Yeah.
maintaining the confidentiality.
Of course, I met somebody recently that came up with let's call it a social networking slash business application for a specific vertical in real estate. And their enthusiasm, and they had just quit their job, saved up some money, quit their job, very young guy, very passionate about the idea. And frankly, it was a fantastic idea. It was a fragmented market that is ripe for consolidation. He also had a defensible moat. He had intellectual property that was protected by patents. So he was in a very good spot, so that he really impressed me.
Okay. So you mean to say that the problem matters the most? There should be a real demand for what they are, solving.
It should be a problem that it needs to be solved. A
Okay.
100%.
So let's move a bit about private equity versus public equity because this was something that me personally I was pondering a lot about. So let's say while starting out, which one is better to start with? Investing in stocks, which is public equity, or investing in private companies using debt, meaning private equity, and both of them in comparison, which one is better in the long run?
Well, I started with public markets, so I'm going to obviously lean into that. Public markets are driven heavily by liquidity, sentiment, macro conditions, short-term reactions. They have quarterly earnings reports. So they're talking about going to, twice a year earnings reports right now. Private markets are more relationship driven, patience driven. The information is going to move slower than something that's publicly traded. Access and relationships matter probably more so in private markets than the public markets.
Okay, so which one is better in the long run? Which one? Like, I totally understand that it really depends on the company, but if you take an average, which one would yield you higher returns in, let's say, 10 years, 15 years, 20 years?
In a 10-year time frame, the private markets are going to give you a higher return typically. They outperform in a 10-year time frame. Over time, the private markets are, a 50-year time frame. The private markets, weren't really developed that long ago in when you're looking at that big a time frame, so it's really hard to tell. Um, in private markets, the best investments happen before the broader market understands that the opportunity even exists. Whereas in a publicly traded company, it's more, even if it's a small company, it's just more established.
Yeah, totally. That makes sense. So, uh, to be honest, I'm a lot into investing and finding asymmetrical bets and risk management. So, what creates outsized returns in your perspective over long periods of time and mid term periods of time, like 5 years, 10 years time frame?
Well, the challenge is that what's going to give you those returns is that humans tend to do the opposite of what they should be doing. That's why people bet against smaller retail investors and tend to align money more with institutions. So, what's going to give you the upside over 5 to 10 year time frame is number one, staying power. Okay, if you're margined up or you're leveraged, you're not going to have staying power to make it maybe 5 months, not even 5 years, in my opinion. I've seen a lot of people, most bubbles, I think every bubble is driven by being over leveraged. So that's number one, leverage. Number two is that you would have to find something with a big enough addressable market, as I told you, but that's got that specialty niche. At least that's how I invest. And expertise in that niche. And the last thing I would say was that you've got to have a management team. When you're looking at investment management, believe it or not, is one of the most important. Um, I know a company, Summit Therapeutics, where the founder and the CEO had a drug that was an absolute failure, but then the stock almost went to zero. However, he was able to sell the assets, purchase a different asset, and the stock went to $30 a share because of that. And that was a direct result of the management team not packing it up after the first failure and reorganizing the company. So that management team saved that company clearly.
So, how do you personally think about asymmetrical risk and reward opportunities right now and when you earlier started on in your public equity journey?
I would definitely say that I took on more risk when I was younger, which was rewarded because I started, like I said, in the 90s in the internet and, was in the right place at the right time. But a lot of life is that, being in the right place at the right time. So what I try to do is to answer, your question about gaining alpha in a directional market is you've got to cap your downside, whether you want to use stop loss orders or whatever you want to use in the public markets. And in the private markets, it's with capital allocation. If you do one round, you don't have to do the second round or the third round of financing. That would be the equivalent, that you can really only lose what you've got in. So the downside is, if you can kind of handicap your downside, the upside typically takes care of itself if you've done the right amount of due diligence.
So, how do you think about the exit? Like, when do you decide that this? How do you evaluate that this stock has reached its peak and I think it's a time to exit? How do you evaluate that?
Nobody knows the bottom of a stock and nobody knows the top of a stock.
Totally.
So, what I try to do is when I enter a position, whether it's public or private, I do what I said. I scale in with equity and then I scale out. You know, people say you never go broke taking a profit, but you want to stay in for as long as possible because successful companies typically compound their success. And compounding is obviously, one of the wonders of the world.
Yeah, totally. So, I just had a question. So, when you started out, how did you manage to, you know, consolidate the capital to invest in public stocks?
I was very passionate, and this was during the 90s. I picked up a telephone and a list of very wealthy people, and I called, hundreds of times a day, and I didn't take no for an answer. So that's how I started my original book of business. I was able to get referrals from them, and now the bulk of my business is referrals. But originally, it was knocking on doors over the phone, so to speak.
Sort of like the Wolf of Wall Street.
I know people that had worked out at Stratton, where Jordan Belfort's from. That was out actually where I grew up, out in Long Island, New York. It's a suburb of New York City.
Okay, sure. So, the last thing in this topic, what is your framework about leverage and using debt to acquire companies? How do you think about it? Let's say you want to buy a business. How do you think about it? Because a lot of people say that you should use debt and control an asset that's worth more than what you put in and that can generate outsized returns. So, how do you think about debt and leverage?
I'm not a big fan of taking on a lot of debt or leverage. There's ways to be successful without doing that, as Warren Buffett has done. But then there's guys like Carl Icahn that have been very successful using leverage buyouts and things like that. So it kind of has to go in sync with your personality. My personality, personally, is taking on a lot of debt for what you perceive is undervalued asset is not the way I would play things.
Okay, that makes sense. So, what are some other mistakes that a lot of young people make while starting out and investing in public equities, stocks, whatever you call it?
Most people overtrade their account. Like I said, successful companies compound their successes, whereas weak companies typically compound their weaknesses. Also, another thing is that most people, a guy I worked for said, you pick your weeds in the garden, you don't pick the flowers. And what I mean by that is they sell stocks that are doing well and performing and take profits, but they're very hesitant to take losses. So what happens is by them just selling all their profits, they're left with nothing but stocks that are underperforming. And a lot of times they're underperforming for a reason.
Totally, totally. So, what is your opinion about cryptocurrencies, stable coins? There are huge amount of coins popping out, and obviously there are the main ones: Bitcoin, Ethereum, Solana.
Hmm.
How are you investing in them? How are you going about thinking?
I'm not, I missed that boat, but as the expression goes, you can't dance with all the girls at the wedding, you know.
Yeah, totally, totally. Okay. Moving on to private equity. So, how is it that family offices think differently from venture capital or other traditional funds? Because right now, me personally, I'm working with a lot of infrastructure and manufacturing deals. for which we're actively targeting family offices. So, how do family offices think about evaluating deals in your perspective?
Well, obviously it's their money, and when it's your money, you tend to be closer, obviously, to the situation, to any situation, than somebody that's raised the money from someone else. That's just intuitive. However, it would vary significantly by family office and family office, and it also geographically. Family offices in Europe run completely differently, or I shouldn't say completely, but they run differently than family offices here in the United States.
Okay, totally. I mean, it really depends. So, in private equity, when someone is starting out, how does one, bring in the capital? Is it through LPs, taking on debt, or there are like multiple ways for it? So, how do you recommend someone consolidating the capital while starting out in private equity?
You have to do LPs. That would really be how you do that. And you would do that by doing a friends and family outreach at first, and then nowadays you would use social media. You would use LinkedIn. You would use you know some form of social media. I'm very re- well versed in LinkedIn, but not so much in some of the other verticals, so I can't really speak to them.
Totally, totally. I mean, social media and personal branding have become huge nowadays. I mean, I've seen your profile. I think 18,000 followers or something like
Mhm.
that on LinkedIn.
Yeah.
So,
Yeah.
how does that help you with investor relations over time? Because
Um,
for me, I'm getting a lot of founders contacting me, but I got really bad luck with investors.
yes, you're always going to have more luck with people looking for money than people looking to give you money. That's
Totally.
just the way it is. I think the biggest way that I've been able to leverage my LinkedIn connections is that I treat them as real individuals, and I've met a very high amount of the people that you see as connections on LinkedIn. And I try to provide value. When people reach out to me and they want to utilize me for a connection, if I can give them the referral or make the introduction, I do. If I can honestly do it, and I have some experience and honest reason to base that on.
Okay, totally, totally. So, do you have any, a framework for networking? How do you go about networking? Because obviously, in investment banking, networking matters the most if you want to close a deal, and in private equity as well. To get a deal flow is the most one of the most essential things because the one with the best deals wins. So how do you go about
Yeah.
building that network online as well as offline? Any frameworks that you use?
Most of my relationships for things like deals, sourcing deals, are from personal relationships. My firm has a relationship with Alexander Capital, and we were able to get um, on things like Anthropic, Twitter, XAI, and a lot of very lucrative transactions very
Totally.
early on, and that's from personal relationships. But you can also use LinkedIn and other fashions of social media, because all you can do is now you can just zoom somebody and you can see them and build a personal relationship. I have several clients that I've built off of Zoom calls.
Totally. I mean, for me, it's totally online because I'm in school all day on my laptop. I mean, it's unhealthy, but frankly, that's how I network. So, yeah, I mean, I'm pretty much bullish on LinkedIn and connecting online. This podcast is online as well. Um, yeah, that makes sense. So, how is it that you compound your network over time? In the long run? I know the network effect, but is there a way to speed up the process of networking?
Yes. Yes, provide value. When you make posts and things like that, provide value. When you reach out to somebody in a specific business, if you've got research or some kind of connections that can help them out, you provide value. That's the answer to that question, clearly.
Totally, totally. So, ending with this podcast, I want to get a bit into your life philosophy and your mindset because at the end of the day, like it's the mindset that determines whether a person wins or loses. I mean, it's not binary, but some people think of it that way. So,
Hmm.
what was your mindset and your motivation to pursue this career? Obviously, you told me that you had a family background in it, but was there something else that kept you pushing? Was it for the money or was it for the freedom? Um, any,
Initially,
yeah,
I'll say that initially it was for the money. That's what attracted me to the business as an
totally,
18-year-old. They tell you that you can make at the time $100,000 a year was a huge amount of money. And I knew that I knew personally people that were my age making, six figures a year. So I was attracted to the money. But you don't stay in a business for 32 years for the money.
totally.
You
You
stay
should
in
love
it
what
because
you
of the
do. Yeah,
passion and the love of the industry and the business. And I've got, every year at least 6 to 8 interns from around the world that I take on. And, there's really no benefit to me monetarily from having an intern. I do it because I want to mentor people in a business that's been good to me over the past 3 decades plus.
totally, totally. So, what were your some core values that drove you towards the remarkable success that you've achieved in this industry? A lot of people give credit to consistency, discipline, patience. What were some of these qualities in you, or the qualities that you very much intentionally developed in order to achieve what you've achieved?
Obviously, discipline and work ethic are key in any business, but I think optimism, believing in yourself and the situations that present themselves to you. There are a lot of doomsayers out there about the American economy and about the stock market and about other things, but over time they've all been
Yeah,
proven wrong.
totally. Yeah.
So what I try to do is I try to take an approach of the cup being half full rather than half empty, and that personality trait is something aside from discipline and work ethic, obviously, but that personality trait has
Yeah.
really paid off in spades for me, I would say.
Okay. So, so are you originally Texan or are you from New York?
I'm originally from New York. I
Okay.
grew up out in Long Island, and then I moved to New York City when I was 17.
So, how do you go about your relationship with God and religion, spirituality, whatever you call
Wow.
it? Because that's one of the aspects that a lot of big people ignore in business. For me, it's really important, but I don't know. Some people totally ignore it. So, how do you go about that?
For me, it's really important. It was really important early on. I'm a practicing Catholic, and I went to an all-boys Catholic school, very strict school when I was a child. And I kind of carried that early on to my career. I got away from it in the mid portion of my career, and then I got back to it, I would say, about 15 years ago. So it is important to me. I know people in the industry that aren't religious or they don't even believe in God or a higher being, whatever you want to
Yeah.
call it. But I don't really know how they do it. If I didn't have belief in a higher power, I don't think I'd have as much confidence in anything.
Okay, that makes sense. I mean, it's if you involve God in your personality, it totally changes from my perspective, and obviously I can be wrong. One of the last questions is throughout your journey, if you had to summarize all the lessons that you've learned and give it to the younger generation, what would it be?
I would say tenacity and optimism. Your ability to look at the best situation, the best of the situation, and then to exploit that, to be able to extrapolate that into a successful outcome, and the tenacity of when things are going bad, like the subprime housing crisis in the United States, or 9/11, or COVID, or any of these things. The ability to continue to get up every morning and punch in and do the same thing that you did yesterday, that separates the winners from the losers.
Okay, and just wanted to ask a sub question regarding this question. What would your best advice be for the younger generation starting out in the stock market specifically?
In the stock market, I would say look at where the big money's putting their money. Obviously, guys like Warren Buffett make mistakes all the time, but they don't make more mistakes than they do, right decisions. So I look at things like insider buying. If the CEO and the board of directors are buying the stock, that's a very one of the most bullish indicators that you can have out there. If firms like Stephen Cohen's hedge fund are buying the stock or things like that. It definitely makes me look at a stock. In healthcare, it would be like the Baker brothers buying a company. I would definitely look at that. So I try to see where other people that I believe are smarter than me are putting their money. So that for publicly traded stocks, that's what I would say.
Okay. And one of the last questions that came to my mind is that how do you go about wealth and money? Because to be honest, greed is a sin, but it's a human desire to pursue money and material success. So, how do you balance giving back to the society and doing good things and enjoying life with the money aspect and getting rich and working hard? How do you go about thinking about money, and like what's your take on money?
My take on money, I'm very conservative, fiscally. I'm not somebody that, drives a Rolls Royce. I'm not going to say I never had nice cars because that's not true. But as I got older, I think it became less important. And I think a lot of that has to do with my relationship with God, as you mentioned earlier. And also, I think having children. What's important to you changes a lot. I have twins that are 8 years old. So 8 years ago, that was a significant change for me financially. You think differently.
Okay, yeah, that has been a great answer. Balancing money and obviously experiencing life to the fullest is something that everyone needs to balance. So, yeah, I mean, we've learned a lot. Me personally, I've learned a lot from this specific chat. Thank you so much for being on the show and hoping for a continued success for you in your journey, and hopefully, the audience has also found it really valuable. So I'd like to end it over here. Thank you so much
Sure.
for being on the show, BizGrow Podcast. I'm signing off. If you want to say anything, you can have a word with the audience.
No, I just appreciate the time that you gave me and thank you for having me. It's been great to get to know you better.
Have a nice day, sir. Thanks a lot. Yeah.
Bye.